Hello everyone, this is Madhvi Mehta from Kotak Securities Commodity Research Team and welcome to another session of Commodity Catch-up where we'll discuss major market developments as well as price outlook for major non-agriculture commodities. While looking at recent price movement, we can be sure that the inverse relation between commodities and the US dollar index remains intact. This trend may continue in the near term amid continuing focus on central banks. Commodities at large rose for the second consecutive week, gaining support from weakness in US dollar, improved risk sentiment and supply risks. Gold has recovered nearly 5% from March 2021 lows set earlier in the month. Industrial metals also rose for the second consecutive week, led by sharp gains in copper and zinc. Crude oil also ended higher but continued largely within the recent trading range. The US dollar index fell for the second consecutive week and has corrected more than 3% from 2002 highs set in early July. The US currency weakened amid mixed economic data, lower bond yields, and reduced safe haven demand. A switch from safety of US dollar to riskier assets benefited equity markets as well. US DJI index ended higher for second consecutive week and tested a 7-week high. European and Japanese equities also ended higher. Chinese equities, however, ended with marginal losses, reversing the gains noted a week ago. A move out of the US dollar also increased appeal for other conventional safe havens. The US Treasury bonds rose for the third consecutive week, while Japanese yen and Swiss franc also ended higher. The biggest event last week was Fed's monetary policy decision, and the outcome was largely as expected. However, it still managed to cause volatility in larger financial market and has intensified debate about Fed's future moves. In line with market expectation, the Fed raised interest rate by 75 basis points, similar to the pace of hikes seen at its June meeting. The Fed also emphasized that the priority is to get inflation under control, which means that rate hikes may continue. The Fed's move to raise interest rate at a similar pace to that in June was seen as a sign that the central bank is halting to assess the impact of tightening on economic activity. This, along with comments from Fed chairman and some disappointing economic readings, fueled debate if the central bank may slow down the pace of rate hikes. Fed Chair Jerome Powell said that the central bank may slow down at some point and that they will take a meeting-by-meeting approach to decide on future moves. Mixed economic data from US highlighted increasing challenges for the economy, making a case for Fed to slow down. Amid the latest, US GDP fell 0.9% in second quarter, as against market expectation of a modest 0.5% growth. However, inflation readings highlighted that the price pressure is still high and the central bank needs to act. The PCE price index rose at the fastest pace in 40 years. University of Michigan 1-year consumer inflation expectations dipped marginally, but 5-year expectations fell less than forecast. Overall, there is no major change in Fed's stance, and rate hikes may continue until the inflation situation improves significantly. However, the central bank has now taken an open-ended approach, and market players may react to key economic numbers to determine Fed's next move. Some commodities also benefited from supply risk relating to Russia. Russia last week reduced the natural gas supply to European countries through the Nord Stream pipeline to 20% of capacity, citing maintenance issues. Amid increasing risk for Russian supply, European countries adopted voluntary reduction of natural gas consumption, but with exemptions. Outlook for European economies have been clouded by uncertainty about Russian gas supply. However, it has also added to concerns that production activity may be hampered, leading to tightness for some commodities. While commodities ended higher, concerns about China and global economy kept a check on the upside. Economic data from major economies has been mixed, highlighting increasing challenges, while inflation data shows continuing price pressure. The latest reading from Europe showed that consumer prices rose at a record high pace in the month of July. Adding to concerns was a downbeat growth outlook. The IMF lowered the 2022 global growth estimate from 3.6% to 3.2% and warned that the global economy could be at the cusp of a recession soon. China struggled to get virus spread under control, and its strict adherence to zero COVID policy has dented outlook for the economy. Meanwhile, measures taken to support the economy have failed to boost market sentiment. The Chinese Communist Party top leaders met last week and called for efforts to strive for the best outcome for economic growth. The top leaders announced no fresh measures and made no mention of growth targets. This fueled concerns that the economy may struggle to reach the 5.5% growth target set earlier this year. Overall, Global growth worries are intensifying and have dented demand outlook for commodities. However, market players see this as a sign that the central banks may slow down monetary tightening, and this has helped revive risk sentiment. We may see volatility continuing as market players may assess economic data and central bank comments to gauge economic health, as well as outlook for central bank monetary policy stance. The key event in the coming week is US non-farm payrolls report, which will highlight the health of labor market. Forecasts indicate that jobs growth slowed last month. A slower rise in jobs will highlight stress in the economy and may further strengthen the argument that Fed should slow down the pace of rate hikes. The US dollar may also get impacted by monetary policy decision of other central banks. Bank of England is due to hold its monetary policy decision this week. BOE has been raising interest rate at a steady pace of 25 basis points since December last year. With inflation still out of control and other central banks increasing at a faster pace, market players are debating the possibility of a bigger 50 basis point hike. If BOE takes a hawkish stance, it may put additional pressure on the US dollar, which is already under a corrective phase. Other key events this week includes manufacturing and services PMI from major economies. China's official manufacturing and services PMI data released over the weekend failed to meet market expectation. Manufacturing PMI dropped below 50 level, indicating contraction in the sector. Also in focus will be development relating to virus spread as well as Russia-Ukraine war. While focus remains on China, virus cases are rising in other countries as well. Adding to concern is the increasing spread of monkeypox, which has been declared a global emergency by World Health Organization. Let us now start with individual commodities. We'll start with gold first. Gold rose for the second consecutive week, recovering further from the March 2021 low set earlier in July. Gold edged up, gaining support from weaker US dollar and lower bond yields as market players debated Fed's monetary policy stance amid slowing economic activity and persistent inflation. However, weighing on gold was continuing ETF outflows and concerns about consumer demand in India and China. World Gold Council in its latest report highlighted that the demand is expected to be flat this year. Gold's sharp fall in last few days made it vulnerable to short covering, and a close above 1750 level shows that the momentum has turned positive. However, we still do not expect a sustained rise as Fed may continue with its tightening stance unless inflation comes under control. The trading range we see for the week is 50,500 to 52,600. Moving to silver, silver also rose for the second consecutive week and has recovered more than 12% from July 2020 lows set earlier. Silver edged up amid concurrent gains in gold and industrial metals. ETF outflows, however, show that investors are using higher price to exit the market. Silver was one of the worst performing commodity in last few weeks and was long due a correction. While the momentum looks positive, we do not expect a sustained rise amid weaker investor interest, persisting concerns about China, and Fed's monetary tightening stance. The trading range we see for the week is 56,300 to 60,500. Moving to industrial metals, let's start with copper first. LME copper jumped above 7,900 level, supported by a softer US dollar amid increasing bets of slower pace of rate hikes following Fed decision and a dismal US GDP report. Risk sentiment remained high despite IMF's downbeat growth outlook. Going ahead, we expect copper to see extended gains on fear of prospective supply disruptions as some copper producers demand clarity on Chile's proposed tax overhaul before making fresh investment. Meanwhile, mining executives in Peru doubt president's ability to boost the mining sector. However, market players may remain cautious ahead of US jobs report. The trading range we see for the week is 620 to 684. Next, let's talk about aluminium. Aluminium prices started the week on a negative note, hurt by rising Chinese output amid muted consumption demand. However, prices made a recovery and touched a one-month high, helped by a consistent decline in LME inventories in last 2 months. Aluminium stocks at LME warehouses plunged below 300,000 tons for the first time since 1991 and suffices only a day and a half's worth of usage globally. Despite last week's recovery, we expect aluminium to trade with a negative bias amid concerns about Chinese economy, as top leaders did not announce any fresh stimulus and maintained commitment to strict COVID-0 policy. Forecast of higher Chinese aluminium production in the second half may also keep pressure on prices. The trading range we see for the week is 207 to 227. Next, let's talk about zinc. Zinc prices gained the most last week by rising by nearly 10% and closed above the 3,300 level as European gas rose amid reduced supply from Russia. Market players fear that complete cutoff of Russian supply may delay restart of European smelters amid tight local supplies. After the sharp rise last week, we expect to see some correction in zinc as demand may take a hit from output cuts in Chinese steel mills amid muted construction activity. Lower stocks at LME warehouses and European gas crisis may, however, keep a flow to prices. The trading range we see for the week is 270 to 314. Lastly, let's talk about lead. Lead prices traded lower for most of the week amid a pullback in downstream demand. However, prices made a modest recovery and closed marginally higher for the week as the social inventory of lead ingots across major centers fell by more than 6,600 tons. Going ahead, lead may trade lower next week as some secondary smelters that were under maintenance are expected to resume production in early August. The trading range we see for the week is 170 to 184. Moving to energy complex, let's start with crude oil. Crude oil witnessed mixed trade but ended higher for the week, gaining support from weaker US dollar, gains in equity market, supply risk relating to Russia, and sharp decline in US crude oil and product stocks. However, weighing on price was demand concerns amid downbeat growth forecast and mixed economic data from major economies. Crude oil has traded in a broad range of about $90 to $100 for last few days as demand concerns are offset by supply risk. Crude may remain choppy as supply risk and demand concerns are unlikely to subside soon. However, we expect selling price to emerge at higher levels amid increasing signs of stress in global economy. The key event for the week is OPEC plus production policy meeting. OPEC and allies have reversed all the production cuts announced during the pandemic. The oil producer group is not expected to raise output significantly due to weakening demand outlook. However, it has been factored in and we may not see much price impact unless there is a surprise outcome of the meeting. The trading range we see for the week is 7,250 to 8,350. Lastly, let's discuss natural gas. Natural gas jumped to fresh 2008 high but shed almost all the gains to end marginally higher. Natural gas hit fresh highs amid short covering near contract expiry. The momentum, however, halted amid mixed factors. Supporting price was robust cooling demand in US, tighter US gas stocks, and higher European gas prices amid reduced supply from Russia. However, weighing on price was reduced LNG exports from US, robust gas production, and concerns about health of US economy. Natural gas has come off the highs, but so far it has managed to hold near $8 level. We expect buying interest to emerge at lower levels amid tightness in US and global market. The trading range we see for the week is 560 to 750. Well, that's it from my end. I wish you all a very happy trading week. Thank you.